Good morning and happy Friday. Jordan Keck here, your lender buddy with your weekly market update. Kicking off, unfortunately, interest rates continuing their trend higher from 6.43% last week to 6.62% this week. Remember, that is the average for lenders across the nation for borrowers with top tier credit and situations. So this is before any buy downs, but if you lower interest rates, lower credit scores are in place, we might see a few clients looking to tick into the 7% range again here. I know it's been a while since we've been up this high again. We were touching 599 for a little while, but everything is driven by Iran and the oil situation right now. We'll get into a few details to make sure you're up to date on what's going on there. But in the meantime, wanted to talk about our weekly mortgage tip, which is temporary versus permanent rate buydowns. This is going to be a hot topic right now as we're looking at affordability here, ways to keep monthly payments as low as possible. And so wanted to give a refresher on these different tools. They can be used together. So you can use a temporary buy down and a permanent buy down at the same time, but they're very different calculations. The permanent buy down, that's where you pay in additional closing costs. Typically it's around a 4-to-1 cost. So if you're buying down a 0.5% in rate, it's usually about 2% in cost. Not always, but it's a rough ballpark there. So figure it's a 4-year break even. If somebody is planning on being in the home before refinancing or paying off their loan for 4 years, it makes sense. And it makes a bigger bang for the buck than if you were to put the same amount of money as down payment. So that's one option. Right now, temporary buy downs, while I don't love them as a means of being able to afford something you otherwise wouldn't have, it can be really good in situations where you can afford the regular payments anyway. You're just looking for a way to use up additional seller credit and front load all of the benefit. The way it works is you're paying for exactly the amount of benefit you get. The break even is exactly that cost, so it doesn't make sense to have it be paid by the buyer because you're essentially saying, here, please take $10,000 of my money and give it back to me slowly over the next 2 years. But if it's something where you have extra credit from the seller and you can apply it either towards a permanent rate buy down, lower price, or a temporary rate buy down, a temporary rate buy down is going to give you the vast majority of the benefit up front. So rather than saving, say, $100 to $150 a month over the course of 30 years, you're looking at maybe $600 a month for the first year, for $300 or $400 for the second year, and then the benefit is gone. Again, you can use these together if you have an additional amount of seller credit available. Can do permanent, can do temporary. If you have any questions about running numbers on that, what that looks like, let me know. Happy to be able to provide those for you. So going into the situation with the Iran war here, it's been a long week with a lot of things happening, so I'll kind of give this to you in the order it's happened so you can keep up to date on it and avoid a lot of the noise. So virtually every day we've seen big swings in the market because of changes in expectations. Remember that the markets are going to react to what they believe is going to happen, not necessarily what has already happened. If what has happened is what they expected, markets really aren't going to change. But we're seeing a lot of information here. Trump last weekend threatened to attack Iranian power plants if they did not open the Strait of Hormuz within 48 hours. This is because a lot of oil cannot get through, so we've seen almost a doubling of oil prices. In retaliation, Iran said that they would strike purchasers and holders of U.S. treasuries. There have been numerous times where one side would directly contradict what the other one is saying in terms of negotiations or potential peace talks, leading to confusion about what's actually happening and the potential for peace or for a longer war. Thursday saw a 15-point peace plan from the U.S. to Iran, and Trump said Iran agreed to the most important part of the plan, which is no nuclear capabilities. Since then, Iran's foreign minister told media that they're reviewing the proposal, but have no intention of having any talks with the U.S. So again, markets saw the peace plan as a good sign. The Iran coming out saying they don't want to talk with the U.S. is a bad sign. Trump then later posted that Iran better get serious soon, leaving markets to believe that talks have not been constructive and are preparing for an escalation. Trump also extended today, he said the U.S. ceasefire is going to be extended for 10 days, but in the meantime is still sending more Marines, sending some mixed messages to the markets, and Iran and Israel are still trading missiles. So that is what has been happening up to the time this was recorded. That could all change here this afternoon and over this weekend, so markets are bracing themselves for more volatility here as we still don't have a good idea about what's going to be happening, how long it's going to be happening, and any potential for the Strait of Hormuz to be open, or even for warships to be escorting cargo tankers of oil. Next up, we did get the ADP employment data for February, showing an average of 10,000 jobs per week created. This is on track for about 40,000 for the month ending March 7th, the 4 weeks ending March 7th, was slightly above the previous report, which only showed 9,000 jobs per week average created, but still only about 40,000 for the month, which is fairly weak. The last BLS jobs report showed 92,000 job losses, and the March jobs report will be released on April 3rd. Be interesting to see how those numbers compare. The MBA, the Mortgage Bankers Association, reported that mortgage applications last week dropped due to higher rates. Kind of a no-brainer on that one. Purchase applications fell 5%, but are still up 5% year over year, and refinances fell 15%, but are still up 52% year over year, and refinances are making up 50% of all mortgage applications for the last week. And lastly here, Apartment List has their national rent report, which showed rents rose 0.4% for March month over month alone. This is the hottest month of rent growth in the last 3 years. And on a year-over-year basis, new rents are still down 1.7%, which is the biggest decline, bigger than the previous decline of 1.5%, and is the lowest rent growth year-over-year since 2017. As always, hopefully this is helpful. If you have any particular questions that I don't cover, feel free to reach out. Always happy to help. Have a great weekend. We'll see you next time. Take care.